Good afternoon, everybody. We're going to go ahead and get started. There are some people still joining, but in respect for your time, we want to get rolling this afternoon. So welcome. This is our final session for our May retirement series. My name is Terry Hecker. I'm the Wellness and Benefits Consultant at MCW, and I appreciate all of you that have joined us through these 6 different sessions we've had in May. And this is our final session. We hope you find it helpful. We're going to discuss top tax savings tips, as you can see. And I would ask that you please make sure you're on mute. And any questions that you would have, please put in the chat. We may stop periodically, or we may go until the end. We'll pick the cadence, and I can assist Tim with that. Tim Shirk is here from Francis Investment Counsel. You may be familiar with him by now. He's done a lot of sessions for us, and we get such wonderful feedback. We ask him to keep coming back, and he's been willing to do so. So we appreciate that. So with that, I'm going to turn it over to Tim, and we'll get rolling.
Okay, thank you, Terry. Give me a thumbs up. You still hear me all right? All right, thank you everybody for your time and attention this afternoon. I appreciate it. Today, my job is to talk about some top tax savings tips. This will focus primarily around the world of retirement, but we're going to dip into some other categories as well. My email appears on this first slide, and it will appear on the last slide as well. If you have any questions, as Terry mentioned, please chat them in. I will check occasionally, and she'll help me out with that, and I'll answer them as I can. And if I can't, I promise I will go try to find an answer for you. This is one of those situations where you do need to know I am not a tax advisor. So picture this being a needs awareness kind of thing, and certainly talk to your tax advisor for advice specific to your situation. Now, typically, we don't get the opportunity to meet with you individually. However, this time around, we are running a little bit of a drawing. Attendance to this meeting will give you a chance to win a meeting with one of our advisors. If you do win, you'll receive a certificate with instructions how to take advantage of that. Work with your advisor, put together your plan, and then just make sure that you provide feedback to the medical college related to your experience. It's worth repeating because we're going to be all over tax. And this is typically what we do with taxes. We say, we are money advisors. I'm a certified financial planner, been doing this for about 17 years now. I am not a tax advisor, so I cannot provide tax advice. I'm going to talk about all I know about taxes, but your situation is unique. Please talk to a qualified tax advisor. If you're going to implement a strategy that I said this is probably a good idea for you, make sure you talk to a tax advisor. For introduction, there are 2 basic kind of taxes that I want to talk about today. The first one you're very, very familiar with, that is income taxes. In the United States, there is what we call a progressive tax system. As your income increases, you pay a higher percentage of your income in taxes. Looking at this chart, you can see if you are married filing jointly, this is your section. If you are single, this is your section. That just is based on how you file. If, for example, you earn $20,550, and let me step back a moment and say this is after that standard deduction. Now, there are all sorts of ways that you can itemize, all sorts of fancy strategies. Those have become less valuable as some changes in the tax code recently have happened, but I'm guessing they will become very valuable again. For a lot of us, our standard deduction, married filing jointly, about $25,000, is high enough that for a lot of us, we're not going to be able to have enough exemptions and deductions in order to itemize and get a bigger benefit than that. But basically, married filing jointly, the first $25,000 of income is not included as taxable. It is a standard deduction. Then the next $20,550 is going to be taxed at a 10% rate. Now, as you would expect, that would be $2,055, 10% of $20,550. When you start earning more than that, between 20,550 and 83,550, now you're at a 12% tax rate. And then from 83,550 to 178,150, now you're at a 22% tax rate. If you are single, you will have similar tax brackets, 10, 12, 22, 24, but they will start at different income levels. They will start at lower income levels if you are single. Now, I point this out because one of the biggest confusions I get is, oh, if I make $178,151, I'm now in the 24% tax bracket, and I will pay 24% of $178,151. The answer is no. You will pay 24% of $1, and you will pay 22% of $83,550 through $178,150, and you'll pay 12% of $20,550 to $83,550. So we have two different rates that I may reference later. One is your marginal rate. Your marginal rate is how much your highest dollar of income is charged. In this example, if I had $178,151, my marginal rate is 24% because my highest tax amount is 24%. However, in this example, my effective tax rate, which is what I pay in taxes, in this case, about $30,427, divided by my income, that's my effective rate. It's about 17%. Okay, so marginal rate is what your highest income dollar is charged. Effective rate, total of what you pay divided by your total income. So that's the progressive income tax system. There's a second type of tax that's common, and there are some others. There's things like sales tax and state and local and that kind of thing. But the other one that's very common that we're going to discuss today is what we call capital gains. This is what you will experience in accounts outside of your 401k and your IRA, or excuse me, your 403b and your IRA. Your 403b, your IRA, when we talk about taxes there, and we will, we're thinking about the income taxes. When you're talking about a brokerage account, we call it a retail account. You just go buy a mutual fund from a mutual fund company. You buy a painting and it increases in value. That's what we call a capital gain. Capital gains happen when you buy an asset and it increases or decreases in value. If that asset increases in value, you have a capital gain. If that asset decreases in value, you have a capital loss. And typically it'll increase or decrease in value based on how badly someone else wants to buy it. So if you buy an asset that other people really want to buy and it gets more and more attractive, you'll have more and more gain. You can sell it for a higher price. Now, there's some nuance in the capital gains world I got to introduce. There's something called basis. Basis is what you paid for the asset. I bought an asset for $500. I have $500 of basis in it. Basis is what I paid for it. Now, because other people are more and more interested in buying this asset, I could now sell it for $600. Well, remember, the capital gain would be the difference between what I sold it for and what I bought it for. So I would sell it for $600. I have $500 of basis. I have $100 of gain. All right. So far, so good, I hope. All right. Now, if you buy an asset and you sell it inside of a year, 365 days, you have what's called a short-term capital gain, and that is treated in the same way that income is treated. All right, so you pay short-term capital gains. The capital gains tax will be the same as your income, be the same as the brackets. If you have that asset and hold on to it longer than a year, you have long-term capital gains. Those are taxed as a long-term capital gain, and that has a little bit different rate. I'm going to show you these. So for 2022, you can see the rate for what your filing status is. In the middle there is the married filing jointly. If your income is between $0 and $80,800, the long-term capital gains tax rate is actually 0. So I'm married filing jointly and I make less than $80,800. I buy that $500 object. I hold it for more than a year. I sell it for $600. I have a $100 capital gains and I observe no taxes because I'm in a 0. Now, if my income is between $80,800 and $501,000, the rate is 15%. Now, if you compare that to what a person who's has an income tax rate at $445,000, that rate would be 35%. So generally speaking, capital gains, long-term capital gains taxes are currently generally more advantageous to you than income taxes are. All right. Now, I know that we're getting a little bit into the weeds there, and we're going to get, next slide is going to get into the top tax tips, but I needed to get into a little bit of weeds here. And this is a tax meeting, so you kind of expected some weeds, right? Because taxes are just weedy. One more thing I need to mention is dividends. Dividends is when I own a stock. Let's say that $500 asset I bought was a stock, and it is 5 shares of a stock. And the company that stock is in wants to reward its shareholders, the people that own it, that hold shares. They'll do so by offering them a dividend. Maybe they offer you $10 per share that you hold. I hold 5 shares, so they're going to give me $50 in dividends. Those dividends are taxable as income. If they're qualified, and the vast majority of them are, they'll have the same rate as the capital gains rate. In this case, if I have under $80,800, no taxes. Between $80,000, $501,000, 15%. So capital gains, dividends, both generally tend to be more advantageous than income tax. That said, talk to your tax advisor because some dividends are not qualified dividends. Most of them are. Now, remember that thing called basis? I paid $500 for it. It grew to $600. So I've got $500 of basis and $100 of gain. That $50 of dividends that I ended up paying taxes on, that's now basis. I've got $550 of basis, and I've got $650 of value with $100 of gain. All right. So let's dive into some of the tax tips. All of that leads into tax tip number 1, take advantage of capital gains tax rates. Capital gain tax rates are generally better than income tax rates. However, there is commonly talk about changing capital gains tax rates. And this is one of the hazards of being in a democracy. Every 4 years, we replace our president. Every 2, 6 years, we replace senators or Congress people. And so we generally tend to change. One group's want lower, one group wants higher. Not a political statement. We'll let someone else argue what's better, okay? But the reality is capital gains is one of those taxes that's not as easily understood and often gets mentioned. They'll float the trial balloon. What if we change capital gains tax rates? Right now, they're very advantageous. Just be watching. Future administrations may change that. So take advantage of capital gains tax rates. I'll tell you another way to do that in a moment. The other thing you can do with capital gains that you can't do with income taxes is you can offset those gains, those capital gains and losses against your income tax burden. So this is a nice thing about capital gains. If your capital losses exceed your capital gains, you can claim up to $3,000 married filing jointly, and that $3,000 will reduce your tax burden for this year. More on why that's important in a moment. If you have more than $3,000 of capital loss after compared to capital gains, you actually may be able to roll that over into a future year and claim those capital losses against future taxes. So one of the things, and talk to your tax advisor, remember this is needs awareness. One of the things you can do with this is when you have losses like you're having now in some of your assets, if you hold them in a brokerage account rather than a 401k IRA, you can actually take those losses and offset them against current taxes. Now, typically we encourage you try to hold on to investments for at least 1 year. If you're talking about capital investments, you're talking about a stock or a bond, generally speaking, you go 366 days. It's a long-term capital gain. If you go 364 days, it's a short-term capital gain. As mentioned before, the long-term capital gain is better. So tax tip number 1, if you buy that Bitcoin, right, that's getting pretty popular. Where can I go buy Bitcoin? That's likely going to be a capital type asset. If I buy a stock in a brokerage account, holding it for 1 year generally results in a better tax than holding it for less than a year. Also, I would say, if you have individual equities, or if you have more speculative equities, or if you have like Bitcoin, for example, if I'm going to invest in cryptocurrency, maybe I'm going to invest in one of the more speculative Bitcoin or speculative cryptocurrencies. Generally speaking, I would encourage you invest in those in a brokerage or a retail account rather than in an IRA. I know Fidelity's talking about getting them into IRAs and retirement plans. If you're going to invest in single stocks, single company stocks, you want to buy Tesla and you have an account that allows you to buy individual assets, generally speaking, I'd rather see that in a individual account like a brokerage or retail account rather than your 401k or IRA. The reason for that is if you do have losses on that speculative asset, who knew that Dogecoin was going to fall apart and I was going to lose a bunch on it? If it's in an IRA, I don't get to claim any losses. If it's in that retail account, I do. Okay, I'm going to stop here. I don't see any questions in the chat box. Terry, we're still good? All right, good, because that would be the hardest ones to answer. All right, so tax tip number 2, use Roth accounts to control your tax bracket in retirement. This goes to this answers one of the questions: how will Roth help you in retirement? Now, when you think about should I save Roth or pre-tax, generally what comes to mind is, well, I'll probably be paying lower taxes in retirement, and as a result, it makes sense to delay paying taxes. And that's what most of your tax advisors will tell you, and it may be very true. But there is some real advantage to holding some Roth in retirement, even outside of the dollar for dollar bang for your buck in terms of tax break now. Let's say that you want to stay below that 22% tax bracket. So I'm going to put a red line there under the 12% tax bracket. So you don't want to get into that 22% tax bracket. So you're going to have your standard deduction, which right now is $25,000. And then on the next $20,550, you're going to draw that out of your pre-tax account and pay 10% on it. And on the up to $83,550, that you'll draw out of your pre-tax account and pay 12% on it. But in order to keep from going into the 22% bracket, if you need to draw more, you draw that more out of your Roth account. And that Roth distribution is not taxable. It's not included in your income, so you can stay under that 22% bracket. Now, there are other brackets. I believe we talked in the Zero is the Hero. We talked about how Social Security becomes taxable. If you weren't here to watch that, watch the video. And at certain income levels, your Social Security is either not taxed, or only 50% of it is taxed, or 85% of it is taxed. And by having Roth, you can control where that limit is. You may be able to reduce how much you pay for other things like Social Security. There's one other advantage to having the Roth. The Roth makes a really good emergency fund in retirement, tax-free emergency fund in retirement. I'm being very careful to stay under that 22% tax bracket, and then the roof leaks, or the car quits, or the water heater explodes. Now I got to pull another $20,000, $30,000 out of my retirement account to get all these things fixed. Okay, I pull that out of my Roth account, I stay under that bracket. Okay, pull out of the pre-tax, it will impact my taxes for the year. So lots of tax flexibility. But Tim, I make too much money to save Roth. Heard that a couple times. The answer is, some of you may make too much money to save in a Roth IRA. Not everyone can save directly in a Roth IRA. They do have income limits. You can find your tax filing status in the middle column. Okay, so let's say you're married filing jointly. If you make less than $204,000, you can save up to the limit $6,000 this year, unless you're over 50, then $7,000 in a Roth IRA directly. Okay, assuming you have income. If you make between 204 and 214,000, you can save a reduced amount. If you make more than 214, you can't save in a Roth IRA. More on what to do about that in a moment. If you're filing separately, it's a really low limit. And if you're single, it's lower, 129 to 144. That is true of a Roth IRA, but it is not true of your Roth 403b. You may save in your Roth 403b regardless of what your income is. 2022, the limit is $20,500, or if you're over 50, it's $27,000. Now, this is in addition to what you can save in a Roth IRA if you're saving in a Roth IRA as well. So potentially, if you're over 50, you could do $27,000 in your Roth 403b, and you could do $7,000 in a Roth IRA. And I think I got a question. What makes you a qualifying widow? Email that question to Terry, and I will find the tax code that describes that, and I will forward that to Terry. Okay. Now, if you like the idea of having some Roth, you could consider converting your Roth, and you can do that in your 403b. Terry, I think we shared the Invest with Confidence document for the last group. Did we share that for this group?
We did not share that for this group, so I can definitely email that to this group at the end of the session today. We're going to share the slide deck, the recording. I can include this document as well.
All right, fantastic. So it will explain how you can, you'll just go to Transamerica to do it, how you can actually convert pre-tax balances. So you haven't paid taxes on them yet. They're in your 403b. What you do is you pay taxes on the portion that's pre-tax, and in that year, that conversion is considered taxable as income, and then it goes into the Roth side. It's treated as Roth from there on out. Now, you don't have to convert all of it at once. You can convert a little bit at a time so that you aren't overwhelmed by taxes. So I'm going to convert maybe $5,000 this year. I'm in the 20% bracket, so it's going to cost me $1,000 of taxes, something like that. Pre-tax balances are considered taxable, but no penalties are applied in the conversion process as long as you're not using your retirement balance to pay the taxes. If you use your retirement balance to pay the taxes, the portion that you pulled out for paying taxes, that's considered a distribution. That would end up being taxable. If you pay your taxes from outside sources, that would be more important perhaps in an IRA, that would be then non-taxable. Now is probably as good a time as ever to talk about timing. We've talked in previous meetings about how the Roth is more valuable for those who are younger. The younger you are, the more time you have for growth. And as a result, the better the Roth is. 20-year-olds saving $100, that could be $1,600 by the time they retire. No brainer, pay taxes on $100 today, so you get $1,600 tax-free in retirement. 64-year-old saving $100 today, it's going to be $107 in retirement. No brainer, wait to pay your taxes in retirement. Question is it taxable if you are over 55? There is a 55 and severance exception to the qualified distribution rule, but you would have to terminate your employment in order to take advantage of that. And since you like your job, you probably don't want to do that. If you were over 59 and a half, it wouldn't be taxable because it would be a qualified distribution. That's my answer. Check with your tax advisor. That's my best answer. All right. So generally speaking, the younger you are, the better the Roth is. And I'll answer this right away. Medical College does offer a Roth 403B. More on that when you get the Invest with Confidence. And I would encourage you, if you want to do Roth, do it. All right. The Transamerica person can help you with that as well. All right. Now, the Roth is better if you're young, but it also is a good idea when the market's down. Let's think about this. The market is down now. In fact, you've probably lost everything that you earned through most of last year. Doing a conversion today, you will be paying taxes on your shares at the price you would have paid last year. If we can get this market to lose another 30%, be down 50%, you could be paying taxes on shares at the price they were years and years ago, essentially artificially making your age younger. So when the market goes down in value, you have to pay taxes on the value of the shares that you convert. If the market loses half of its value, you can essentially convert twice as many shares for the same tax cost. So having the market go down in value makes it a more valuable time to do the Roth conversion. Essentially, it's like allowing you to go back in time and make a purchase at or pay your taxes at a lower cost. Now, talk to your tax advisor about doing this, because I don't want you to go in and convert all of your 403B and then take your situation to your accountant and have them have a heart attack. All right. So make sure you talk to your tax advisor, your accountant, before you do a conversion, to make sure you don't bump yourself up in another bracket or really hurt some kind of tax strategy you might have. Now, if you like a Roth IRA, you can also convert your traditional IRA. If you have a pre-tax traditional IRA, it used to be that you were only able to make that conversion if your income did not exceed $100,000. That excluded a lot of folks. If you were married filing jointly, you both had decent work, you were above 100,000. That recently changed thanks to the Taxpayer Relief Act of 2012. Now anyone can convert. And again, the way that works is any pre-tax amounts that are converted are considered taxable income in the year of conversion, and no penalties apply. The good news is that once you've done that, all growth from there on out will be considered tax-free. It'll be treated like the Roth. So when you pull it out, all of your contributions to Roth, all of your conversions to Roth, and if you're over 59 and a half years old and it's been 5 years, all of your gain will be income tax-free when you pull it out. See an example of this. You've got a $10,000 in a traditional IRA. You want to convert it to a Roth. In the year of conversion, say you're paying 22% in taxes, you pay $2,200 in taxes, and that $1,000 is moved into a Roth conversion bucket, and it now starts growing income tax free. Tim, that's nice, but I make too much money to save in a Roth IRA. Well, here's where I'm going to introduce you to something called the backdoor Roth IRA. Now, I have to preface this conversation once again with a reminder that I'm not a tax advisor. It'll be really clear why in just a moment. You need to work with a qualified tax advisor to get help if you want to take such an action. This needs awareness. I'll present the process, and I'll include a warning a little bit as to why you should talk to a tax advisor. But this is the content of the backdoor Roth IRA. Let's back up and talk about something we haven't introduced yet, and that is an after-tax IRA. Not everybody can save in a Roth IRA. We've seen that if your income's too high, you can't save in a Roth IRA. Not everybody can save or can deduct contributions to a traditional IRA. But everybody may save in an IRA. I used to say, I think I said this last time, I used to say, Donald Trump can save in an IRA. And that got really politically challenged. So I said, Elon Musk can save in a IRA. And that kind of got politically charged. So now I say Bill Gates, he can save in an IRA. He just can't deduct his contributions. He can't claim it for taxes. So let's look at, if you are single and your modified adjusted gross is $68,000 or less, you can deduct. If it's between 68 and 78, you can get a partial. If it's more than 78, you can't deduct. You can make a contribution, but you can't deduct it. It'll be after tax. Married filing jointly, it's between 109 and 129. Pretty low limits. So those who make too much money to deduct, they make a contribution. It's called a traditional after tax. Traditional after tax. And it looks like this. I make an after-tax deposit because my income is too high. So I've paid taxes already. I'm in a traditional after-tax account. My maximum contribution is $6,000 or $7,000 if I'm over 50. When I take the money out, my contribution portion is not taxable. My gains are taxed when withdrawn. So in this case, I contributed $6,000 and now it's worth $8,000 when I take it out. The $6,000 that I contributed, not taxable when I take it out. The $2,000 of gain is taxable as income when I take it out. Now, in an after-tax traditional IRAs, only the gains are taxable when you take it out, and only the gains are taxable on conversion. So we're going back to the backdoor Roth example. You contribute to a traditional after-tax IRA. Say you put $5,000 in, you get no tax break on it today. Your income, you make $220,000 is too much to save in a Roth IRA. It's too much to deduct a traditional IRA. So you contribute to $5,000 and you pay taxes on it. You can't claim it. In a short time, it grows $500 and you convert it to a Roth IRA. You convert all $5,500, but you pay taxes only on the gain. So you make too much money to save in a Roth IRA, but by doing a traditional after-tax contribution and then doing a conversion, a two-step process, you get into a Roth IRA. That is a backdoor Roth IRA. Now, a couple comments on this, and this is why you have to talk to your tax advisor. Number one is if you already have some traditional IRA money out there, the IRS will include that in the math when you do the conversion. So you've already got $5,000 in an IRA, and you choose to do that backdoor Roth IRA, so you make a $5,000 contribution to an after-tax IRA. The balance at conversion, the IRS says, is $10,500, not $5,500. They include this $5,000 of existing money. As a result, you don't pay taxes on just the $500, you pay taxes on 52% of each dollar converted. So if you already have some traditional money out there, the backdoor Roth may not work for you. Now, the second reason you want to talk to your tax advisor, there is something called a step transaction doctrine. The IRS has a rule that says if you take two legal steps in an effort to make one illegal step, they can consider the two steps as one step and call it an illegal act. All right. So it's totally legal for you to make a traditional after-tax contribution to an after-tax IRA. It's totally legal for you to convert to that money to Roth. However, the IRS could come in and say these two steps are actually one step in an effort to do something illegal, and we're going to call it a step transaction. Now, thousands of people in America are doing this with thousands of different tax advisors, and I'm not suggesting you shouldn't do this. I'm suggesting you talk with a tax advisor first. It's likely that if you talk to your tax advisor, they'll say, yeah, Tim doesn't know what he's talking about, okay? And if they say that, I say amen, all right? Now, that said, he or she will then explain to you why this won't be a step transaction. It may be because we make the contribution in January and we make the conversion in July. It may be because the contribution is $10,000, but the conversion is $5,000. They'll have their own way to make it look like it's two different steps. All over the country, people are doing this. The point is that tax advisor is qualified to tell you how to do it. I am not. So the point of this is just make sure you talk to someone who knows your tax situation and knows the tax code to walk you through it. Otherwise, a lot of people are doing it to very good effect. All right, number 3, required minimum distributions. Third tax tip, try to avoid them. Okay, now the good news is the federal government's helping us do that by pushing off the date. It used to be that at 70 and a half years old, the IRS said, you've had your tax break too long on your traditional IRA and on your pre-tax 401k, and now we're going to force you to take out a certain amount each year so that we can charge you taxes on it. And it's a pretty simple calculator. If you just Google irs.gov and RMD, that's the required minimum distribution, RMD worksheet, there'll be a works PDF that comes up, and it's really simple. Step 1, write down your balance from the previous December 31st. Step 2, find a number from a table. Step 3, divide. That's how much you have to take out. And the first number, your 70, is somewhere in the neighborhood of 24. So divide your balance by 24. That's how much you have to take out this year. And it changes as you age. They just recently moved this, effective 2020. They moved it to 72 years old. So you can hold on to your money a little bit longer. There's a couple of other ways you can hold on to your money. One is by continuing to work. You're still working at medical college because you love what you do, you help people out, and it gives you joy. You're 73, 74 years old. You typically, unless certain conditions apply, but most of you, probably all of you, will not have to take required minimum distributions until you retire. So if you're working beyond the RMD age, that's one way to avoid it. The other way to avoid it is with Roth IRAs. Roth IRAs are not subject to RMDs. Now, your Roth 403B at medical college, that is subject to RMDs. 403Bs, 401Ks, they are subject. IRAs are not. So you're still working at medical college at 72, roll your IRAs into your 403B, and then you don't have to pay taxes on them. All right, that's a tax option. You're not working anymore, but you've got the 403B at medical college, roll it out into a Roth IRA. It will no longer be subject to required minimum distributions. There's one other way you can kind of avoid the RMD. You still have to take it, but it's what's called a qualified charitable distribution. You want to give money to a charity, and you have to take money out of your IRA anyway. You can kill two birds with one stone. You can accomplish both. It has to be from an IRA, not from a 401k or 403b. So this will require a rollover if you're in the 403b, and it can't be from a SEP or a simple IRA. You have to be over 70 and a half. That's the old age for required minimum distributions, and it has to be paid directly from the IRA to the qualified charity. So you want to give money to a cancer charity. You can talk to your cancer charity. They'd be happy to tell you all about it. Talk to your tax advisor. They'll be happy to show you how to do it. Your IRA provider, if you're doing it on your own at Vanguard or Fidelity, they'll be able to help you with it. Essentially, what you do is you have the IRA pay that RMD directly to that qualified charity. You're giving money to the charity you wanted to give money to anyway, and you're getting the RMD satisfied. So that's a qualified charitable distribution. Talk to your tax advisor for more on that. Number 4, move Roth 403b to Roth IRA before RMDs began. Remember, the Roth 403b accounts still do have RMDs. So when you get to that age, if you're still in the 403b plan, but you're not working there at medical college anymore, roll that into an IRA, a Roth IRA, so you don't have to take RMDs. Number 5 used to be consider a stretch IRA. It's not anymore. Stretch IRAs have been eliminated, but that's partly a good thing and partly a bad thing. So this was a great strategy we used to be able to have, but it did get changed. Here are the old rules for the stretch IRA. Investopedia.com has some great information on how this worked. Essentially, if I was not married, for my kids, for example, my kids could roll over an inherited IRA into a beneficiary IRA and take withdrawals over their lifetime. So we could essentially stretch out the taxes, not to my life expectancy, but the life expectancy of my kids, so I could stretch out that tax break a lot longer. Now, that was changed. The new law says you must take a distribution within the first 10 years. Now, here's the good news, bad news. In the olden days, under the old stretch rules, they either had to take all their money out in 5 years, so they didn't have to take a distribution until 5 years, or they had to start taking in year 1 and take it based on that younger person's life expectancy. They changed the date, so now you don't have to take anything for 10 years, but you have to take it all by the time 10 years is up. Well, I've talked to, I've heard from a lot of tax and estate planners, and they say in reality, most of these kids, they get these stretch IRAs and they can't wait to buy a fancy car with it, right? And so practically speaking, what this change did, this change extended the 5-year window to the 10-year window, where you don't have to take any distributions for 10 years, then you have to take the distribution by the 10th year. Have a conversation with a tax advisor when you take it. If it's a Roth IRA, it won't be taxable as income. If it's traditional, you will. The other piece that's good, the pre-tax distributions will be taxable at the beneficiary's tax rate. So not my tax rate, but my kid's tax rate, which might be lower. And if you inherited the IRA before 2020, you're in the clear. You can still do the stretch IRA. Other folks that are still entitled to do the stretch, if your spouse can stretch out the IRA for their life expectancy, a disabled person can, a minor child, so that 10-year clock doesn't start if my kid is 14. It's not until they're 18. And a person that's less than 10 years younger than the deceased. So again, if I'm giving it to my brother and he is, my age, just a little bit younger than me, he can still stretch it. So a lot of the advantage went away, but they also gave you that nice 10-year window. Tax tip number 6, be the best grandparent or parent ever. All right, make a Roth IRA contribution for the kids. Joey gets a job mowing lawns and shoveling walks, and he makes $1,500, $2,000 in a year. Joey, at 14, can make a contribution to a Roth IRA. And remember, Roth IRAs are fantastic for young people. The younger you are, the better. A Roth IRA is phenomenal for a 14-year-old. Now, Joey may not want to make that contribution, but you could. And you could also, if you wanted to be a real sly parent, you could do a match. Joey, you contribute $100 and I'll contribute $100. So Joey can actually have $200 going to their account. Now, it would be a custodial Roth IRA because Joey's not an adult. So Joey's mom or dad would have to sign for it. Parent would have to sign for it. But then the other nice thing about that Roth IRA for Joey or for Jill, if she's shoveling snow and mowing lawns, maybe Joey's babysitting, we'll just cross those sexist expectations and say everybody can do anything. Joey or Jenny can take money out of that Roth IRA tax and penalty free at any time, the contribution portion. So you put $2,000 in that Roth IRA for Joey, and it grows to $3,000 by the time he turns 18. At 18 years old, if he wants to use that Roth for paying for college, $2,000 comes out tax and penalty free. The gain of $1,000 comes out penalty free because he's using it on college, just taxed. So lots of great reasons for a young person to do a Roth. Also, you get them started in a Roth account, saving for retirement. Boy, I wish my mom and dad had forced me to do that or done it for me. All right, number 7, sell your home tax-free. We wanted to throw this in here. Did you know you can sell your home for tax-free? Capital gains tax on assets, that is true also of your home. For many, the value of your property has increased over the time you've owned it, especially recently. We saw prices go up pretty dramatically. If you sell for a higher price than what you bought it for, you will be selling for a capital gain. You may exclude up to $250,000 if single in capital gains, or $500,000 if married filing jointly. You must have owned and lived in the property as your main residence for 2 of the last 5 years. Make sure you keep your receipts. If you've done home improvements, they may be used to claim. You can claim those as well when you're looking at improvements for the tax deduction when you sell your home. When we're talking about BN, this is actually almost my last slide. When we're talking about being the best grandparent ever, you know, the other thing I'm going to swerve into here, you can contribute to a 529 plan as well as a Roth IRA. That does a couple of things. One, it gets them started saving for college. It keeps the assets out of the parent or the kid asset, so it's not included in the expected family contribution. And there is, I believe, you can save 15, or you can contribute, give $15,000 to anybody for any reason without having to even record it for tax purposes. That's a little bit more related to tax exclusions, tax and estate. More on that in another class. But you know, you want to be a great grandparent, a great grandparent. Consider a 529 plan. That'd be other way to get into a tax advantage, growing asset saving for school. Terry, that's what I have. I guess I'll give it to you and open it for questions as you desire.
Okay, thank you so much. I want to let everybody know, Tim just mentioned the 529 college savings plan. We are going to be having EdVest do a session similar to this for us. And I have 2 sessions scheduled for August 2nd. They are on the wellness events calendar in case you don't write these dates down. August 2nd, 11:30 to 12:15, and August 10th from 5 p.m. to 5:45 p.m. So we will have an expert from EdVest that can help you with how to put money aside for, you know, your children or grandchildren. You can contribute to them, and as Tim said, be a great parent and a great grandparent. So those sessions are happening in August. And then we also have an estate planning, if that's something you're interested in. Transamerica is providing, we didn't do that during the retirement series session this year. We try and change things up. We did one last year, but they are having an estate planning session on June 7th and June 17th. Again, those events are on the wellness events calendar. So if you're interested, please don't hesitate and go out there and look at those. All the sessions are recorded, and I will get these posted on the financial wellness site once they're available, including today's session and all of the sessions from the May retirement series. So we do have a question. How often do these regulations and limits change? Are they usually changes and adjustments with new federal administration?
Yeah, so some of these changes have built-in changes. So for example, the amount that you can save in your 401k or 403b or IRA changes with inflation. When inflation demands a $500 change, that's when they'll change. So last year it went from $19,500 to $20,500. There was a $1,000 change. So if inflation demands it, it's kind of built into the math. Those are announced usually in November. So you start getting notes in November. In terms of rates, also they will announce like 529 plan things. That's a state thing. So the giving, to avoid gift tax, that exclusion, that changes. The IRS announces that at the same time. 529 plan contribution limits are really high. That's a state thing. Check with EdVest. By the way, if you're listening to the EdVest person, pay real close attention to the difference between advisor sold and direct sold. If you go to ABC Broker and set up a 529 plan, it's likely you'll just pay a higher fee. Set it up directly with EdVest and just avoid that fee. Other limits, some limits are locked in, some are manually adjusted. Tax rates obviously change with administrations. So, you know, we don't know when or if they will, but the limits in terms of what you can save and the income limits as to when you can and can't save, those do change regularly. And I got another one here. If recipient of a beneficiary IRA dies, does the remaining balance pass on to the spouse? That beneficiary IRA will have a beneficiary designation as well, I believe. So you would check the beneficiary designation in order to determine where it would go. That would be what I believe would happen to that. Typically, a spouse would typically be the beneficiary, but in terms of Terry, email that one to me. Let me get back to folks on that in case I'm getting that wrong.
Okay.
Because you do have to, you aren't going to be able to circumvent that 10-year window, but you know your beneficiary will have a beneficiary designation itself. So yeah, let me get back to you on that. Thank you.
Okay, I will note that one. The other thing I want to let everybody know is on our 403B internal site on InfoScope, we post the maximum contribution levels allowed. You mentioned, Tim, we're always waiting every November. And we usually put an article in the wellness newsletter in December each year, notifying everyone that what the current limits are. So we wait for those, and then we share that information. So watch for that every, year around December, because we're
And
always
you know,
waiting.
the other thing I'll mention is if you're just in one 401k or one IRA, your record keeper is going to keep track. So, if you set a contribution for Transamerica that's higher than your limit, they'll shut you off.
That's exactly what happens with us.
Yep.
We have those system protections in place.
Yeah, the trick is if you've got more than one job and you're contributing more than one 401k, or you've got more than one IRA, which isn't as common, but so don't worry about over contributing if you're just saving in the 403B in Transamerica.
Right. We watch, Mark Lash works with Transamerica and watches all of that information very closely. So I don't see any other questions. So we're gonna give you a few minutes before your next meeting. And I thank everyone for joining us. Thanks so much, Tim, for all of your information. It's been wonderful. And we will share the slide deck, the materials, and that flyer in an email. So watch for that in the next day or two. Thanks, everyone.